And now, as the first chapter has opened, the real question becomes what comes next. Because the pressure of silver is not just confined to trading screens, it is gradually pressing upon the very lifeblood of the global financial system, the banking networks and currency trust. And in the last 48 hours, the emergency liquidity drawn from the Fed's repo window indicates that some major institutions are struggling to manage their silver-related risks, with OTC derivatives, forward contracts, and unallocated silver accounts layers peeling back one by one. When prices are artificially suppressed on paper, but physical metal disappears from real markets, someone ultimately faces a delivery failure, and that is the fear currently circulating in the interbank market. Many bullion banks assumed for years that they could always acquire physical silver if needed. But now the reality is that Asia, especially China and Japan, is rapidly drawing metals from the West, and what appears in the New York and London warehouses is only paper inventory, while the actual bars are quietly moving to locations from which they will not return, such as solar industries, electronics manufacturing, and strategic government reserves. This is why industrial buyers are now bypassing COMEX prices entirely and making off-market deals, securing private contracts at $90 to $110 per ounce to ensure 2026 supply. And this is pulling metal out of the exchange, widening the gap between paper and physical markets. Meanwhile, the strategy of COMEX and CME Group is visible, raising margin requirements to signal fear of volatility. Because when leverage is removed, prices temporarily drop. But this is a short-lived relief. History shows that when margins are repeatedly hiked, while physical tightness remains, the exchange must either adjust delivery rules or move to cash settlement. And that is the moment when global investor confidence erodes. Silver then stops being a futures product and becomes a scarce monetary asset. In this equation, China's role is pivotal because it is not merely a supplier, but a strategic player. As it restricts silver exports, the West's dependency becomes exposed. America and Europe have ignored their mining capacity for decades. Environmental regulations and low prices discouraged investment. And now that demand is explosive, new supply cannot arrive instantly. Opening a new silver mine typically takes 8 to 10 years, which means that the demand arriving in 2026, 2027, and 2028 has no quick fix. This is why the market is now realizing that silver prices are not just trading figures, but a barometer of macroeconomic stress. The precious metals tax imposed in Washington state today is part of this broader trend. When governments raise taxes on an asset, it signals that they are recognizing it as an alternative currency. Every time historically precious metals have faced taxation, regulation, or confiscation, it has been a sign that the monetary system is under pressure. And today, America is grappling with massive debt, rising interest payments, and weak treasury demand. In such an environment, attempts to control silver and gold intensify, but the problem is that physical metal cannot be stopped by paper orders. If both investors and industries demand delivery simultaneously, the exchange has only two options: either allow the price to rise or change the rules to halt the game, and both scenarios erode trust. That is why the start of 2026 is not just a new year for silver, but a new phase where this metal has transformed from an investment into a geopolitical and monetary weapon. In the coming weeks, if pressure on the banking system increases, if the Asia-West price gap persists, and if physical premiums remain high, it is almost certain that silver's paper price will be forced to match reality. When this happens, it will not be gradual but sudden and violent, because years of accumulated pressure will release at once. This is why, on January 2, 2026, silver is being seen not merely as a trade, but as a system-level signal, one that indicates the global financial framework has reached another stress point. And when history reaches such junctures, change always shocks those who blindly trust the numbers displayed on screens. And as the story continues, the next layer of tension emerges from the structural supply shortage, because the paper market can print contracts endlessly. But physical metal is finite. Tokyo's silver at $130 per ounce, Kuwait at $106, Korea at $97, and $71 on Western screens, these numbers are no longer a market. They are a confession. Real bars are moving quietly, while the global benchmarks in New York and London remain trapped in a fantasy of leveraged promises. Investors attempting to acquire metal face the reality that the cheapest verified ounce on Japan's largest resale platform, Mercari, is now $130 for pamp rounds. This seemingly outrageous price reflects a system under strain. Silver surged 148% last year. The world is running out of supply. Banks shorting silver require emergency bailouts. China is restricting exports, and COMEX is increasing margin requirements. On December 31st, COMEX raised silver futures margins by 30%. A move signaling desperation to maintain control. But history demonstrates that repeated margin hikes cannot contain physical tightness indefinitely. When leverage evaporates, true price discovery occurs. Industrial buyers, solar companies, electronics manufacturers, and large-scale industrial users are in panic procurement mode, negotiating directly with refiners to secure volume for 2026, often paying premiums far above the global spot price. The West is experiencing a liquidity crunch in physical metal, and arbitrage between East and West is pulling silver permanently toward Asia. The Chinese silver export controls, effective immediately, are intensifying the pressure, because the East now acts as a strategic buyer and the West as a drained supplier. This sets the stage for a vertical move in prices, as paper markets adjust to the scarcity reflected in reality. Meanwhile, banks that previously suppressed prices are flipping strategies. They will be major buyers in early January to capitalize on the inevitable squeeze. The combination of institutional allocation flows, industrial panic buying, and limited physical inventory creates a scenario where paper and physical markets must reconcile, and when they do, the adjustment will be sudden and violent. Investors in Western exchanges will witness a gap-up as algorithmic trading, arbitrage, and physical scarcity intersect, creating a surge in silver price that will redefine global benchmarks. Meanwhile, regulatory changes, such as Washington State's precious metals tax of 10.3%, impact local trading, forcing dealers and investors to adjust behavior, potentially moving transactions out of state, further constricting supply. In the background, the macroeconomic environment adds fuel to the fire. U.S. debt levels, rising interest rates, and impending fiscal events create conditions where silver is not just a commodity, but a hedge, a currency alternative, and a strategic asset. Investors, both institutional and retail, now understand that silver's value is governed by supply-demand imbalances amplified by global geopolitical and monetary forces. As banks tap emergency liquidity facilities and as COMEX manipulates margins, the underlying scarcity becomes ever